Every investment decision comes down to one fundamental question: what is this asset actually worth? Not what the market says it's worth today, what it's truly worth, based on all the cash it will generate over its entire lifetime. This concept is called intrinsic value, and the discounted cash flow model is the primary analytical tool for calculating it. The DCF model is built on a single powerful idea: a dollar today is worth more than a dollar tomorrow. Because money can be invested to earn a return, future cash flows are less valuable in present terms than equivalent amounts received today. The DCF takes every dollar the business will ever generate and translates it into what those future dollars are worth right now. The foundation of any DCF is free cash flow, the actual cash a business generates after paying for everything it needs to operate and reinvest. Free cash flow is not revenue. It is not net income. It strips away accounting distortions like accruals and non-cash charges to reveal the true economic output of the business, the cash that could theoretically be distributed to investors every year. Free cash flow equals EBIT multiplied by 1 minus the tax rate, plus depreciation and amortization, minus capital expenditures, minus the change in net working capital. EBIT represents operating profit. D&A adds back the non-cash depreciation charge. CapEx subtracts real capital investments. The working capital adjustment captures cash tied up in growing the day-to-day operations of the business. Building a DCF starts with revenue at the top of the income statement. You need to understand the business model deeply, how the company makes money, historical growth rates, where the industry is heading, and the company's competitive position within it. Analysts typically project 5 years of explicit revenue, decomposed into volume and price assumptions, with distinct logic for each period of the forecast. From revenue, you build down to EBIT, cost of goods sold determines gross margin. Operating expenses, selling, general and administrative, research and development, are typically modeled as a percentage of revenue. The critical output is EBIT margin, how many cents of operating profit the company generates for every dollar of revenue it earns. You will hear these three terms constantly in finance. EBITDA adds non-cash D&A back to EBIT and is a rough proxy for operating cash flow before capital investment. EBIT is operating profit after D&A, net income is after interest expense and taxes, it's distorted by the company's capital structure and tax situation. In valuation, analysts use EBIT or EBITDA, never net income, as the base for free cash flow. Depreciation and amortization is a non-cash expense, it reduces reported earnings but does not cost the company actual cash in that period. In the free cash flow formula, you add D&A back. But capital expenditures, the real cash spent on factories, equipment, and infrastructure, get subtracted. The relationship between D&A and CapEx tells you how capital-intensive a business is and how much of its operating earnings must be reinvested just to sustain operations. Working capital is the cash tied up in running operations on a day-to-day basis, inventory and accounts receivable, reduced by accounts payable. When a company grows, it typically needs more working capital, more inventory to serve new customers, more receivables as sales increase. This incremental investment in working capital reduces free cash flow and must be explicitly modeled, or you will systematically overstate the cash the business generates. Once you have projected all the free cash flows, you need to convert them into present value. The discount rate is the rate of return an investor requires to accept the risk of investing in this specific business. Higher risk demands higher return, which means a higher discount rate, which means future cash flows are discounted more heavily and are worth less in present terms. For a company financed with a combination of debt and equity, which is most companies, the appropriate discount rate is the weighted average cost of capital, or WACC. WACC blends the cost of equity and the after-tax cost of debt, each weighted by its share of the total capital structure. Typical corporate WACC values range from 7 to 12%, with riskier or faster-growing businesses at the higher end of that range. The cost of equity is calculated using the capital asset pricing model. Cost of equity equals the risk-free rate, plus beta times the equity risk premium. The risk-free rate is typically the current 10-year Treasury bond yield. Beta measures how volatile the stock is relative to the overall market. The equity risk premium is the extra return that investors historically demand for owning stocks instead of risk-free government bonds. Beta measures systematic risk, how much a stock moves relative to the overall market. A beta of 1.0 means the stock moves in line with the market. A beta above 1.0 means it is more volatile than the market. A beta below 1.0 means it is more defensive. Utility companies and consumer staples have betas of 0.3 to 0.8. Technology and semiconductor companies typically have betas of 1.2 to 2.0. The cost of debt is the interest rate the company pays on its outstanding borrowings, adjusted for the tax benefit of interest deductibility. Because interest payments reduce taxable income, the effective after-tax cost of debt is lower than the stated coupon rate. A company paying 5% interest with a 25% corporate tax rate has an after-tax cost of debt of 3.75%, reflecting the tax shield benefit. A standard DCF model projects 5 to 10 years of explicit free cash flows, building each year from the revenue, margin, depreciation, capital expenditures, and working capital assumptions. Each year free cash flow is discounted back to today at WACC to calculate its present value. The sum of these discounted cash flows represents the value from the explicit forecast period, but this is usually only 20 to 40% of total enterprise value. Here is the most important, and most frequently misunderstood, component of any DCF, terminal value. Terminal value represents all the cash flows the business will generate from the end of the explicit forecast period through the end of time, captured in a single number. In most DCF models, terminal value accounts for 60 to 80% of total enterprise value. Getting it right is not optional, it dominates the entire analysis. Here is the most important, and most frequently misunderstood, component of any DCF, terminal value. Terminal value represents all the cash flows the business will generate from the end of the explicit forecast period through the end of time, captured in a single number. In most DCF models, terminal value accounts for 60 to 80% of total enterprise value. Getting it right is not optional, it dominates the entire analysis. The exit multiple method calculates terminal value by applying an industry valuation multiple, typically enterprise value divided by EBITDA, to the final projected year EBITDA. It assumes you sell the company at the end of the forecast period at the same multiple that comparable companies trade at today. This method is grounded in observable market data and serves as a critical cross-check against the perpetuity growth calculation. Summing the present value of projected free cash flows and terminal value gives you enterprise value, the total value of the business including its debt. To get to equity value, subtract net debt, total interest-bearing debt minus cash and cash equivalents. Then divide equity value by the total diluted share count, including options and convertibles, to get intrinsic value per share, the number you compare to the current stock price. Bankers present valuation results as a football field chart, a horizontal bar chart showing value ranges from multiple methodologies side by side. DCF, comparable company analysis, precedent transaction analysis, and LBO analysis each produce a range. Where the ranges overlap represents the most defensible and market-tested valuation zone. This chart is the visual centerpiece of every M and a pitch book and fairness opinion. A DCF model is only as reliable as its assumptions. Sensitivity analysis stress tests the model by changing two key inputs, typically WACC and terminal growth rate, across a defined range of values and observing how enterprise value responds. The result is a two-way data table showing how sensitive the valuation conclusion is to reasonable variations in the model most critical and least certain inputs. The most common DCF mistakes made even by experienced analysts, using a terminal growth rate higher than long-run GDP growth, applying full steady-state margins to businesses still in early scaling phases, failing to run sensitivity analysis on key assumptions, ignoring dilution from stock options and convertible securities in the share count, and confusing EBIT with EBITDA when constructing the free cash flow build. DCF models work best for stable, cash-generative businesses with predictable revenue, utilities, consumer staples, insurance companies, mature software businesses. DCF models work best for stable, cash-generative businesses with predictable revenue, utilities, consumer staples, insurance companies, mature software businesses. They are less reliable for early-stage companies with no earnings history, highly cyclical businesses where the timing of the economic cycle matters more than the long-run average, and financial companies like banks where free cash flow is structurally difficult to isolate and discount. Equity research analysts use DCF to set 12-month price targets for the stocks they cover. They build 3 to 5 year earnings models, apply a terminal value assumption, discount everything back to today, and compare the result to the current market price. Their buy, hold, or sell rating reflects whether the stock is trading below, at, or above their estimate of intrinsic value. The DCF is the analytical anchor of every research report. In M&A, bankers build DCF models to evaluate whether a deal price creates value for the acquiring company shareholders. They model the target standalone value versus its value including synergies. If the synergy-adjusted intrinsic value exceeds the acquisition price, the deal creates value. If the acquirer overpays, even with real synergies, shareholder value is destroyed. DCF is the fundamental check on overpaying for an acquisition. A well-structured DCF model has 5 components: the income statement forecast, the free cash flow build, the WACC calculation, the discounted cash flow valuation, and the sensitivity analysis tables. Every assumption feeds in from a single inputs page. Every output flows from formulas linked to those inputs. The golden rule: never hard-code a number inside a formula. All assumptions live in one place and update the entire model when changed. Always sanity check your DCF before presenting or sharing it. If your implied value is dramatically higher or lower than where comparable companies trade, understand exactly why. Confirm that your projected EBITDA margins in year 10 are realistic and supported by comparable companies. Check that your terminal growth rate does not imply the company will eventually be larger than the global economy, a real and embarrassing error made by even trained analysts. DCF has genuine and important limitations. The model is highly sensitive to small changes in WACC and terminal growth rate. Tiny variations in assumptions produce large swings in output. The analysis is only as good as the analyst forecast assumptions. An intrinsic value can diverge from market price for years or even decades. Warren Buffett, who applies DCF thinking to every investment, insists on a margin of safety, buy only when price is meaningfully below your estimate of intrinsic value. To master DCF modeling, read Investment Valuation by Asvath Damodaran, the most comprehensive and rigorous text on the subject. Damodaran posts free valuation spreadsheets for hundreds of companies on his NYU website. Wall Street Prep and Breaking into Wall Street both offer structured DCF courses that walk through complete models for real public companies, with video explanations of every step in the process.